Claire's just filed for bankruptcy again, and this time over 100 stores could close forever. If you've ever been to a mall in the last 30 years, you know Claire's. But what you might not know is how this tween accessories empire that pierced millions of ears and dominated shopping malls worldwide is now fighting for survival for the second time in just 7 years. In the next 10 minutes, I'm going to break down exactly what happened, why Claire's bankruptcy matters beyond just one retailer, and what this tells us about the future of retail in America. Today we're diving into one of the biggest retail bankruptcy stories of 2025. Claire's Holdings LLC and certain of its US and Gibraltar-based subsidiaries announced on August 6th that it has commenced voluntary Chapter 11 proceedings in the United States Bankruptcy Court for the District of Delaware to maximize the value of its business. But this isn't just another retail bankruptcy. This is the second time Claire's has filed for Chapter 11 protection in less than 7 years, and it could signal the end of an era for mall-based retail. If you're interested in retail industry analysis, bankruptcy case studies, mall retail decline, or business transformation stories, make sure to subscribe because we're going to break down every aspect of this developing story. Let's dive in. Claire's, a mall staple that attracts pre-teens for its bargain jewelry and accessories, has filed for its second bankruptcy in less than a decade. To understand how significant this is, we need to look at Claire's massive footprint. The accessories brand runs almost 3,000 Claire's and icing stores globally, making it one of the largest specialty retailers in the world, focused on tweens and teens. But here's what makes this bankruptcy filing particularly concerning. The filing identifies 1,326 locations that could be closed by October 31st unless Claire's is able to find a buyer. That's nearly half of their total store count potentially closing within just a few months. This isn't Claire's first rodeo with bankruptcy. The bankruptcy filing is the second for Claire's within 7 years, with the previous filing occurring in March 2018. The bankruptcy helped Claire's eliminate $1.9 billion of debt. The retailer exited bankruptcy proceedings 7 months later and gained $575 million in new capital in its reorganization. So what went wrong this time? Let's examine the perfect storm of factors that brought Claire's back to bankruptcy court. The immediate trigger for this bankruptcy filing comes down to one word: debt. The bankruptcy comes 3 months after the private company deferred interest payments due in December 2026 on a $480 million loan. When a company starts missing debt payments, bankruptcy often becomes inevitable. But the debt problem is just the symptom. The real issues run much deeper and reflect broader challenges facing traditional retail. First, let's talk about the competition landscape. Claire's. Chapter 11. Filing follows the bankruptcies of other teen retailers, including Forever 21, as traffic in US shopping malls fades and competition from online retailers like Amazon, Temu, and Shein intensifies. Claire's built its business model around mall traffic, kids and teens browsing with their parents, impulse purchases, and the social experience of shopping with friends. But mall traffic has declined by over 50% since 2010, and Gen Z shops very differently than previous generations. Second, the rise of fast fashion and ultra-cheap online retailers has completely changed the accessories market. Why pay $10 for earrings at Claire's when you can get similar items for $2 on Shein or Temu? The brand has struggled to compete with online rivals as tariffs gnaw at its margins. This price pressure has been relentless and accelerating. Third, there's been a fundamental shift in how young people view shopping and self-expression. Social media has changed fashion cycles from seasonal to weekly or even daily. Claire's traditional business model of stocking accessories for months at a time simply can't keep up with TikTok-driven trend cycles. Finally, the company struggles with weak demand, higher import costs, and a heavy debt burden. It's the classic retail death spiral: declining sales, increased costs, and debt service requirements that consume cash flow. Now, let's look at the numbers that tell the real story of Claire's decline. Claire's, which has stores in 17 countries, said its assets and liabilities range between $1 billion and $10 billion. That's a massive range, which typically indicates significant uncertainty about asset valuations. Never a good sign in bankruptcy proceedings. Compare this to their 2018 bankruptcy, where they successfully eliminated $1.9 billion in debt. The fact that they're back in bankruptcy just 7 years later suggests that the fundamental business model challenges were never truly resolved. Claire's elected to miss June and July rent payments on some stores before filing for bankruptcy, indicating severe cash flow problems. When retailers start skipping rent payments, it's usually one of the final steps before bankruptcy filing. The store closure list is particularly telling. Over 1,100 stores potentially closing represents not just a business downsizing, but a fundamental restructuring of their entire operation. This suggests Claire's is moving away from the mall-heavy model that made them famous. But here's what's really interesting about this bankruptcy. The company said it initiated voluntary Chapter 11 proceedings to maximize its business value and will continue to serve customers both in-store and online during the process. The emphasis on online is crucial. It suggests Claire's recognizes that their future, if they have one, will be much more digital-focused. Claire's bankruptcy is symptomatic of a much larger transformation happening in American retail. The traditional mall-anchored retail model that dominated for decades is collapsing, and we're seeing the casualties pile up. The tween and teen retail segment has been particularly hard hit. Young consumers today have fundamentally different shopping behaviors than previous generations. They discover products on social media, research extensively online, and often prefer to buy directly from brands or through digital platforms rather than browsing physical stores. This generational shift has created what retail analysts call the experience gap. Traditional retailers like Claire's offered a browsing and discovery experience, but today's teens already know what they want before they shop. They're looking for convenience, value, and authenticity, areas where online retailers excel. The mall decline is another critical factor. Shopping malls were the perfect ecosystem for retailers like Claire's. Parents would bring their kids to the mall for other shopping, and kids would inevitably end up at Claire's. But with major department stores closing and mall traffic plummeting, that customer flow has largely disappeared. What makes Claire's situation particularly challenging is their dependence on impulse purchases and experiential retail like ear piercing. These are inherently physical experiences that can't easily be replicated online, but they require foot traffic to be profitable. The timing of this bankruptcy is also significant. We're in the back-to-school shopping season, traditionally one of Claire's strongest periods. The fact that they filed for bankruptcy now, rather than waiting until after the holiday season, suggests their cash flow situation was critical. From an investment and business perspective, Claire's bankruptcy raises important questions about the future of specialty retail. The company had attempted various turnaround strategies since their 2018 bankruptcy, including expanding their online presence, updating store formats, and diversifying their product mix. The fact that these efforts weren't sufficient suggests that some retail segments may simply be too disrupted to save. However, there might still be value in the Claire's brand and business model. The company has strong brand recognition, particularly among their target demographic. Their ear-piercing service remains popular and difficult to replicate online. If they can dramatically reduce their physical footprint and costs while building a stronger digital presence, there could be a path forward. Looking at potential outcomes, several scenarios are possible. Claire's could emerge from bankruptcy as a much smaller, more focused company with maybe 500-800 stores instead of 3,000. They might be acquired by a larger retailer or private equity firm that sees value in the brand. Alternatively, they could liquidate entirely, joining the growing list of retail brands that couldn't adapt to changing consumer behavior. For the broader retail industry, Claire's second bankruptcy in 7 years sends a clear message. Even successful restructurings may not be enough if the fundamental business model is no longer viable. This has implications for other struggling retailers and raises questions about which traditional retail segments can successfully navigate the digital transformation. The human cost of this bankruptcy shouldn't be overlooked. Thousands of Claire's employees face job uncertainty, and many small communities could lose one of the few remaining retail options for young people. The social aspect of Claire's, the rite of passage of getting ears pierced, shopping for prom accessories, or browsing with friends, represents something that online shopping can't fully replace. For investors and business analysts, Claire's bankruptcy is a case study in how quickly retail fortunes can change. Just 4 years ago, the company went public after successfully emerging from their previous bankruptcy. The rapid decline back to Chapter 11 shows how unforgiving the current retail environment can be. The Claire's story also highlights the importance of understanding your customer base and adapting to their changing behaviors. While Claire's did invest in digital capabilities, they may have been too late and too limited in their transformation efforts. Claire's Chapter 11 bankruptcy filing represents more than just another retail casualty. It's a symbol of how dramatically American shopping and youth culture have changed. From a company that once pierced ears and sold accessories to millions of tweens in shopping malls across the country, Claire's now faces an uncertain future in a world where their target customers shop very differently. The potential closure of over 1,100 stores would mark the end of an era for many communities where Claire's was a staple of teenage life. But it also represents the reality of retail evolution. Businesses that can't adapt to changing consumer behaviors and market conditions simply won't survive. Whether Claire's can successfully restructure and emerge from bankruptcy as a viable business remains to be seen. What's certain is that any future version of Claire's will look very different from the mall-based empire that dominated tween retail for decades. If you found this analysis helpful in understanding the Claire's bankruptcy situation and what it means for retail, make sure to like this video and subscribe for more business and retail industry analysis. What are your thoughts on Claire's bankruptcy? Do you think there's still a future for specialty tween retailers, or is this the inevitable result of changing shopping habits? Have you shopped at Claire's recently? And if so, what was your experience like? Let me know in the comments below. And if you want to stay updated on major business news and retail industry developments, hit that notification bell so you don't miss any breaking news analysis. Thanks for watching, and I'll see you in the next video where we'll explore other major retail bankruptcies and what they tell us about the future of shopping in America. Until then, stay informed and keep analyzing.